Thank you, Mr. Chairman. It's been interesting because there's been a lot of rewriting of history, I think, today, and a lot of concern for the sense that this almost, for some of the panel members, that this, what happened in 2008 didn't happen. And it didn't happen because people made bad decisions, people who were acting in a regulatory environment, but also had an obligation, in many cases, a fiduciary obligation to actually be honest about what their products were. And so I'm a little perplexed by this, although I tend to share an attitude that we have an obligation to constantly look back on a regulatory scheme and say, is this working, is this right? But to not go down the rabbit hole too much, Professor Macy, is it possible for Congress to legislate broadly, the end result of which would be only one entity would fall within a constitutional classification?
Sure.
Yep.
I think
that's the only point I wanted to make, that we best not get so embroiled in the consequences and look instead at the regulation. And so this hearing is about 165, and obviously a critical component, and I'm curious, and I'm going to open this up to anyone. When we look at the tailored application of 165, and I think the intent probably was that we can't simply just always put a monetary value and assume that we're going to achieve the intended result. Congress does this very often, maybe perhaps too often, turfing a lot of responsibility to the regulators, and then sits in panels like this and complains because the regulators have done what we gave them the authority to do. And so if, we'll let you play Fed for the day and talk about the current exercise of 165 policy, I guess, Professor Lucas, and say, where do you think the Fed is getting it right and where are they getting it wrong? And if we were going to not look at a broad sweeping change of 165 and the categories of 165, where should we be looking that makes the most amount of sense?
Okay, so I'm sympathetic to much of what you said, and I think that the reason that I came down where I did, which was that it would be reasonable to raise the threshold, is that there are some things that the Fed is doing where, although if I did believe that it would significantly reduce systemic risk, it wouldn't bother me. But I believe that when you do something like ask a very simple but fairly large bank to undergo stress tests, that is a fairly significant regulatory burden that won't result in any reduction at all of systemic risk. And I think that just for general respect for the regulatory system, you want to set up the rules so that you don't annoy or impose costs on institutions
with
where
no
it's really not necessary. So I think it's the stress testing and just the heightened examination. So again, I think that it comes down to the transparency that's already there for those banks, or as Dr. DeYoung put it, the resolvability. It's not clear to me that the Fed doesn't already know everything it needs to know about those banks to deal with the systemic risk, whether they fail individually or collectively. Because if you think about what these regulations are doing, it's actually extremely small. So we're talking about it like it makes a big difference, but in fact, it's a very small difference, because even the ones that are subject to higher capital requirements, it's a very small increment to their capital requirements. So it's not going to make much difference to the total amount of failures. And
Mr. Bart, do you have an input there too?
I think that the graduated tailored approach the Fed has taken makes a lot of sense, and it's particularly been effective at the very largest institutions.
Could you give your response to Professor Lucas's point about, a lot of this is make work and it doesn't add to the quality of the regulation in terms of preventing systemic risk?
My experience with stress testing is that it makes a big difference both inside the firm in terms of improvements in risk management, attention to appropriate capital planning, organizational structure, and data integrity. So I think it actually makes quite a big difference to risk management at the firm. And I think it would be a mistake to not apply that stress testing approach more broadly in the economy.
Yeah, I'm out of time, but I think what you can see here is obviously a difference of opinion. And there isn't anyone on this panel, I hope there isn't anyone on this panel who wants to impose burdens that don't have a public good, instead are just make work. And that's the balance that we're at. We have litmus tests that set a target to provide certainty. I'm sympathetic to the argument that we aren't really, that's not always necessarily the right indicator of what we need to do, but it does provide a bright line. With that said, the response to that, when we're looking at systemic risk, may be to give the regulators more authority, which I have a sense here some of the folks would not be particularly supportive of. And, you know, it's subjective versus a subjective, and it's a tough balance. But, I wasn't here when Dodd-Frank was written, but I'm certainly interested in hearing how we can make it better and how we can streamline it, especially for the small community banks. So thank you. It's been a really engaging panel.